So a pretty dramatic weekend in lots of ways, but interested to hear your take on the macro or the UK perspective on some of those things.
Yeah, obviously horrendous events over the weekend in Israel. Just rolling back a bit, last week's oil market data showed falling gasoline production and rising inventories in the US, implied that gasoline consumption in the US fell by 12 to 13%, which equates to about 1 million barrels of oil a day. So it's substantial demand reduction is the indicator, which is little surprise that the oil price tumbled so sharply during the course of last week. All seems quite a long time ago, given the events of the weekend, which now focus minds back on the supply side of oil. I mean, clearly the atrocities in Israel have understandably caused a spike in the oil price overnight as we wait to see what the sort of geopolitical consequences are of these terrorist attacks in southern Israel, and particularly the consequences for the Arab-Israeli peace process. And I think here much rests on the response, the reaction of Saudi Arabia, who were beginning to intimate last week that as part of the roadmap to recognise Israel, they were going to ease up on the production cuts. Which clearly would be beneficial to the White House ahead of the election year next year. All that's now, I think, being put on hold. The dollar's gone up, gold has gone up, and the oil price has gone up, and risk assets have gone down. That's basically the playbook of where we are for today and probably the next few days. On the macro front this week, we've got FOMC minutes on Wednesday and US inflation data on Thursday, and we've got Chinese trade data on Friday. So quite a mix. I think the world is basically holding its breath right now as the US sending aircraft carriers into the Med. Energean, which is a UK mid-cap oil producer or sort of offshore Israel oil producer, despite what's going on to its underlying commodity markets, the share price is down 14% today because it's right in could potentially become collateral damage in all this. So there's lots going on, but they're my initial thoughts.
It's a good summary, thank you.
In the UK, it's a quiet Monday, really. We've had warnings from Croda that their customers have reduced ingredients, lowered their inventories of ingredients in the beauty and skincare sector, which is impacting their business. And MindGym, which is a training and sort of HR consultancy business, has reported that its clients are deferring commitments to new spending, which, again, along with sort of things like learning technologies, is sort of an area of spend that's probably under the spotlight. But the big event, I think, continues to be Metro Bank, which over the weekend has basically cobbled together a capital raise which substantially wipes out equity holders, leaving the unknown Spaldy Investments as a controlling 53% shareholder, and just illustrates the riskiness of investing in banks. As Credit Suisse bondholders discovered earlier this year, your position can be wiped out in a matter of days, if not hours. Metro's raising a substantial amount of new debt. It's haircutting its existing debt obligations in quite a complex restructuring, which ultimately was necessitated by the PRA's refusal to allow Metro to implement its own proprietary risk control of its mortgage assets. Some of these new bonds it's issuing are going to carry a 12% coupon, and Metro still has to dispose of £3 billion worth of its UK mortgage book. While these things have steadied the ship in terms of the existence of Metro, and the shares are up strongly this morning on the back of this rescue, it's still got to grow itself out of this position. Feels like this has just kicked the issue down the road, and some of the measures that Metro's now got to take, along with growing its loan book double-digit percentage for the next few years in a worsening credit environment, it seems pretty heroic. But so that's
lots still to be done. Yeah.